Another kind of close or distant relative to the pain of paying is called mental accounting. And here's the idea of mental accounting. Sometimes companies have multiple departments, and what they do is once a year they assign money to the different departments. And the money after it's assigned is non-fungible. They can't switch it between them. And if one department runs out of money, too bad. If a department has too much money, they make a big party and everybody gets a new laptop. But the idea is that once money is assigned to categories, money is not fungible. And the idea of mental accounting is that we as individual consumers also work a little bit like accountants, that we assign money to different categories and we spend money according to these categories. So here's a beautiful example that Dick Thaler gives. And the example is the following. You bought a ticket for the theater. It cost you $100. You get to the theater, you open your wallet, and to your horror, you discover that you lost the ticket. Luckily, you have another $100 bill, so you can buy another ticket. Would you buy another ticket? When people ask this question, most of them say, no, I'm not going to buy another ticket. I lost the ticket, it's too bad, not buying another ticket. But what if you bought another ticket? How much would you feel then the theater cost you? Most people say $200, the first ticket plus the second ticket. That's case one. Case two, you haven't bought a ticket yet. You're going to the theater, you're going to buy a ticket, you open your wallet, and to your horror, you discover that you lost a $100 bill. What happens now? Do you say to yourself, I lost a $100 bill, let's not go to the opera? Most people say, how are these related? I lost a $100 bill, why in God's name would I not go to the theater now? And then they go ahead and they spend $100 and get a ticket to the theater. And then how much do you feel that the ticket cost you? $100. Now think about both of these cases. In both of them, you lost a piece of paper worth $100. Once it was called a ticket, once it was called $100. But how it was called makes you feel very different, right? And think back about the accounting story. If you assigned money to the entertainment department, you gave them $100 and the entertainment department bought a ticket, and they lost the ticket, you say, too bad to the entertainment department, I'm not replenishing you. But if you lost money from your general wallet, you don't feel any need for the entertainment department to pay for it. You say, I lost $100. Why should the entertainment department suffer for it? Here's the $100. Go and buy a ticket. So there are a couple of things interesting here. One is that as we assign money to different categories, this assignment controls how we feel about the money. And the second thing is that money that we haven't assigned, money that is in our general wallet category, feels very very differently. Another way to think about this is what happens when you get money back. What happens if you got some money back that is only assigned to one category, like a gift certificate, or after something like a return policy. All of a sudden, because it's assigned to one category, it's easy for us to spend it. It's assigned to that category. Here's another example for this. Imagine that you got paid $5,000 to do a workshop somewhere. And you did it in one of two ways. The money was either deposited in your checking account 6 months ago, and now you show up in Japan and you have this workshop to give. And the second case, they give you the money cash in Japanese yens as you get to the hotel in Japan. Now Japan is expensive. Everything is expensive. Travel, food, drinks, entertainment, and so on. In which of those cases would you have an easier time to spend the money? In the first case, when it was in your checking account, it's already a part of your checking account. It's a part of your wealth, and now you would feel bad about spending it. In the second case, where you have all this amount of money and it's connected to your trip, it's easier for you to spend it because it's more of a connected in the same mental category as your trip, easier to go ahead and spend it. Now you can also see why this notion of mental accounting is kind of connected to the pain of paying and how they are either distant or close cousins. Mental accounting, by the way, is also why we see all kinds of strange things in the marketplace. Why we see, for example, leave money in a low-bearing checking accounts with very low interest on one hand, and on the other hand have high interest credit card loans or car payment loans. And when you ask people about it, they feel like these are two separate domains. These are savings and this is spending, and you don't differentiate the two. And if you think about all of these notions of separating money into different accounts and spending according to these separations, it means that money in our mind is not perfectly fungible. Money have budgets, and depending on our budget allocation to the different categories, that will depend our spending. Now, mostly when we think about mental accounting, we think about it as a mistaken decision making. After all, one of the main benefits of money that is fungible. You can switch it from place to place, but people don't treat it as fungible. But I would like to argue that mental accounting is actually a good strategy given our inability. So what are we asking people to do in reality? We're asking them to think about every purchase, how it could translate to all other purchases. If I buy coffee today, what would I not be able to do? If I buy a car today, what I would not be able to do across all categories. Turns out that's just too difficult to do. So what are people doing? We are restricting ourselves, and we're saying, okay, this is probably not going to be ideal, but I'm going to think only about this bucket. I'm going to assign money to this bucket of, let's call it dinners or entertainment or shopping, clothing, vacations, and I'm just going to think about it in this bucket. Is it optimal? Of course not. Is it leading to mistakes? Of course, yes. But nevertheless, it's constraining the problem. It's creating boundaries for it that are much more clear, and therefore allowing us to work better. So if we were all perfectly rational, then mental accounting would not make sense. But given how difficult it is for us to think about money, mental accounting does help us to partition the problem and at least get one step ahead. Now, if we were going to create solutions for people, if we're going to create new digitized bank accounts that would help people think better about money, you can have two approaches. You could say, let's create something that assumes perfect rationality, and let's help people think about perfect fungibility and how to move money between accounts and what's the right thing to do. That's one approach. The second approach is to say, people are already adopting this approach of mental accounting. Maybe it's naturally a good way for people to think about money. And even if it's not optimal, and maybe what we could do is we could capitalize on this inbuilt approach for partitioning money, and let's help people do that better. So I think if you think about those two approaches, it's kind of, how are we trying to help people think better? Are we trying to get people to think all the way at the level of perfect rationality, or are we taking something that is kind of halfway into it? We're taking something that people are doing that is kind of a shortcut that we already have to think about life and just trying to optimize that. From the two types of solution, I generally more believe in the second one. I believe that we have a better chance of succeeding by taking some natural tendency of processing information and building on that rather than assuming it doesn't exist and build something that is perfect.